and welcome to The Upside. I'm Nicole Correale. Football playoffs are officially in session. The biggest games, the brightest lights, and a lot of pressure to perform. Every fan knows it's not just about star players. It's about the full lineup, the game plan, and who shows up when it matters most. So today, I'm asking, if a game of football was your portfolio, which ETF themes, sectors, and factors should you consider as your starting lineup? Helping us build the playbook today is Fidelity ETF Strategist Mark Verrilli. Welcome.
Thanks for having me.
So good to see you again. So let's recap. Before we start drafting our lineup, let's rewind the tape on the 2025 season. How did the market end in 2025?
Yeah, well, the market ended incredibly well, and the ETF industry had an insane year. Over $125 billion in Canada alone, the biggest year we've had by a large margin. And on top of that, over 360 new ETFs were launched last year. It's actually more securities than the S&P TSX index. So we're starting to get to the point where there's more ETFs than there is individual securities. So there's so much to talk about when it comes to the ETF landscape, and it's really evolving day to day.
So how has the end of the ETF season teed up for what you are expecting to maybe see, or how are things starting to flow now in the beginning of 2026?
Yeah, I think we saw, although a lot of flows last year, some new leadership emerged where traditionally US equities would really dominate flows. But last year, it was a bit of a different story. Canadian equities did really well. That was a big part thanks to gold, which was over 1/3 of our returns here in Canada, and people devaluing the US dollar and trying to protect themselves from that trade. And then we also saw, the emergence of international equities. And those three regions were roughly split in flows, whereas traditionally US equities would have a lot more. So I think investors, when it comes to their equity flows, are really signaling that they're trying to diversify away from the US, whether that's because of tariffs, geopolitical conflict, valuations with tech and AI. It's really signaling that I think there's change to come in what portfolios look like. Traditionally, the US is 65% of the world equity index. And I think a lot of investors were probably over that 65% threshold and are now trying to find ways to maybe pare back their US equity exposure in favor of international equities, try to balance things out a little bit.
So let's kick off this game. If a game of football was your portfolio, it's time to start building the starting lineup. And we're starting where every team wants an edge: offense. In football, offense is about scoring, and in the markets, offense is about generating returns, the themes and sectors that can drive growth, momentum, and earnings when conditions are right. These are the areas investors look to when they want their portfolio to move the ball down the field. Okay, so when you think about offense in today's markets, which ETF, sectors or factors do you consider?
Yeah, what I would say off the bat is every ETF, or anytime somebody buys an ETF or a stock, they're always looking for growth.
Right.
So I don't necessarily love to use the word growth. I kind of prefer to use the word momentum for offense. And momentum can be broadly described as, what's performed well recently, will that continue to perform well? In the US, that was AI and tech last year.
Right.
That was the sector that was really been in favor. And over the last, call it 15 years, tech has been a prominent feature in momentum. So if you were to buy a momentum ETF in the US right now, you're probably buying into that theme. And I would consider that an offensive play. But I think there's other areas of equities that I'd also consider being on the offensive. Those would be small caps and emerging markets. Traditionally, those are more volatile areas of the market, but you're rewarded with higher returns for that volatility. The trend doesn't always hold true. We've seen some poor years of performance from emerging markets. Last year was an exceptional year. And small caps, the trend has reversed a little bit in recent years, where large caps like the Meg 7 have really dominated returns, particularly in the US. But when I think about long-term horizons, like 30 plus years, it's momentum, it's small caps, and it's emerging markets. Those are where you're playing offense.
What's one common mistake investors make when they lean too hard into offense?
Yeah, that's a good question. I think there's maybe, I'll give you two. I'll give you a bonus one here. The first mistake I think people make is how their portfolio relates to their income stream. And by that I mean, if you're working for a tech company, it makes sense to not have a lot of tech in your investment portfolio. Because the worst thing that can happen is, the tech industry has a pullback, your investment portfolio declines, at the same time, you're potentially laid off. So now, your investment portfolio isn't working, you're not getting an income stream, those two things don't align. So you have to be careful about where you're playing offense. And a lot of people can have biases. If you work at a tech company, you feel more attached to the company you're working for. You feel like you have more power over the movement of that stock price, when the reality is you don't know what's coming next. Right. So I think a big mistake people make is having biases in control when it comes to investing in things that they're working on.
And don't put your eggs all in one basket.
Exactly. That was the second one, is simply like, don't put all your eggs all in one basket, and rebalancing is a big component of that. If you've held tech and AI for the last 4 years, 5 years, you've done really, really well. Maybe it's time to consider rebalancing. It's a natural way of buying low and selling high. And it's just getting back to what's the appropriate amount of risk I should be taking in any one sector, getting back to that, not selling it all. You should hold AI, you should hold the Mag 7. Right. These are innovative companies, but you just want to be careful about how much risk you're taking.
So offense helps you score, but no team makes it to the playoffs without a strong defense. In portfolio terms, defense is about staying in the game. It's the part of the lineup designed to manage risk, dampen volatility, and hold the line when markets get tougher. Okay, so when you think about defense now in a portfolio, which themes or sectors typically play a role? And as we start 2026, which ones are top of mind for you?
Sure. Yeah, we'll start with equities, and then we can talk about other asset classes other than equities. Within equities, I think low volatility comes to mind when I think about defense. The whole idea behind low volatility, it's in the name. When the market moves, it should move less than the market does. That's in either direction. So when the market's going down, low volatility stocks and sectors should go down less than the market. The sectors we think about are healthcare, utilities, things that, consumer staples. When the going gets tough, you're still paying your utility bills. If you're in the US, you still need to pay for healthcare. You're still going to the grocery store. So those things are going to continue to work. Other areas that might work are quality companies. This can be from any sector really, but companies that have really, really strong balance sheets, low debt, lots of cash flow, can kind of weather the storm. But moving outside of equities, when I think about defense, I really think about the 40 in the 60-40, which is fixed income, particularly investment grade fixed income. This is the part of your portfolio that should be more resilient. When we look at times like the great financial crisis, we're not really sure if companies are going to be able to, add value to their shareholders. They have to pay off their debt holders. Those are the first people they have to pay with their earnings. So those types of products become a lot more popular in times of stress, and they should act as a buffer when your equity portfolio is not doing well.
Well, you kind of touched on that in my second question, which is when markets are volatile, how do defensive ETFs actually help investors stay invested? We've seen that, like you mentioned in history, financial crisis, but also during COVID, healthcare really, did well, I guess, because everybody needed healthcare at the time and, things weren't looking so great. Can you add to that? How else can it help you stay invested?
Yeah, what I would say is it really takes the emotions out of investing, because the worst thing you can do as an investor is sell at the wrong time, right? And when you have defensive parts of your portfolio that really help stabilize the return profile, it just keeps you in the game. And we can think about like US equities as an example. Over 20 years, if you held a US equity portfolio for 20 years, your range of outcomes is really narrow. The volatility is pretty low. But when you hold over 1 year, that return profile could be anywhere from -40 to +40. So the name of the game is staying in the game. Right. I think defensive parts of your portfolio help you take the emotions out of investing, because that's where mistakes are made.
Pun intended.
Yeah.
Did ETF flows in 2025 reflect the defensive mindset at all?
They did at times, but overall I would say probably not. Fixed income is always popular in Canada in particular because of our aging demographic, right? Baby boomers control most of the wealth here in Canada. They're looking to maintain their earnings rather than grow them with their investment portfolio. So fixed income is always going to be popular here as long as the baby boomers have all of the money, which they do right now. Fingers crossed for the two of us that changes at some point in the future. But also in times around Liberation Day, like in early April, we saw short-term fixed income and low volatility equities really rise in popularity. It's a little bit counterintuitive, but you tend to see defensive products become more popular after you needed them rather than before when you needed them. And the same thing can be said for offensive products. Like flows tend to follow performance, right? So when AI and tech are doing really well, you tend to see more flows going in there. And the opposite is what probably should be true. We should probably be buying a well-diversified portfolio at all times. Right. and rebalancing that portfolio as a way to buy low and sell high. But flows tend to follow performance. So I would say not so much defensive characteristics. It's more or less what equity market was doing well.
Okay, so let's wrap up this lineup.
Yeah.
Special teams. We've covered offense and defense, but every football fan knows games are often decided by special teams. These aren't always on the field, but when they matter, they really matter. In a portfolio, special teams are the tools investors use to fine-tune outcomes, manage risk, generate income, or respond to changing conditions without overhauling the entire lineup. Okay, so special teams. Is this covered calls, cryptos, alts? Lay it out for me.
It's the Wild West, I would say, in some regards. This area of the market has really, really grown. I think ETFs are a big part of that, but it's embedded option strategies like covered call ETFs. A lot of those were launched last year, particularly covered calls on individual stocks. So NVIDIA is an example of a stock that became really popular for covered call strategies. You have alternatives, you have commodities like gold, you have crypto. There's a lot of different areas to play with when it comes to special teams and it comes to alternative investments. It's a part of the portfolio that you really need to do your homework on because the outcomes could be wildly different from product to product, even within covered calls. If you're writing a call at the money, you're trading some of your growth potential for income. But if you're writing out of the money, you're giving up some of that income with the hopes of having more growth. Although those products, the names probably sound very, very similar when you're going to purchase them, the investor experience is completely different. So there's a lot of different special teams players, and you really need to understand what they're going to do and do they align with your goals at the end of the day.
Now, correct me if I'm wrong, but did we not see a lot of investor movement into alternative investing in 2025?
It was one of the highest growth areas. When it comes to total assets, equities and fixed income still dominate, of course. But when it comes to growth year over year, the growth in alternatives was huge. And ETFs play a huge role in that. Even commodities. Let's talk about gold for a second. 10 to 15 years ago, ETFs held maybe 20% of the total value of gold. Now the number is more like 75%. So ETFs have clearly made these alternative asset classes more accessible. And I think investors are really starting to grab a hold of that. And I think 2022 is a big reason for that. That was a year where equities and fixed income both went down and they were highly correlated, which is unusual, but because interest rates were rising so quickly, it did some weird things to the market. So I think since then, we've sort of shifted the conversation from a 60-40 to a 60-20-20. I think we still have a long way to go to get to that point, but it's certainly a big push amongst the advisor industry here in Canada to use more alternatives in your portfolio.
We've slowly seen that shift, and I've seen that shift as well, and sort of the sentiment around, slowly leaning away from the 60-40 into, like you said, the 60-20-20.
Yeah, you just want things that are different.
Yeah.
Right? Investing 101 will tell you if you have income streams or return streams that move in different ways, that's going to improve your risk-adjusted return in the long run. Mm-hmm. But with alternatives, the thing you need to be careful about is, overexposing yourself to risk. Like crypto is a great example. Crypto can be an excellent portfolio diversifier because it tends to behave differently in equities and fixed income. But if you have too much crypto in your portfolio, you've materially increased your volatility, you've materially increased your risk, and that could have a huge impact on your long-term goals.
Thanks, Mark. Well, I don't know about you, but I think I'm ready to build my dream team. So if a game of football was your portfolio, today's takeaway is simple. Winning lineups aren't built on one star player. Offense helps you move the ball, defense helps you stay in the game, and special teams gives you the flexibility to adapt as conditions change. The goal isn't to win every play, it's to stay disciplined, diversified, and positioned for the full season ahead. Thank you for joining me on The Upside today. For more investor content, be sure to subscribe to our YouTube page to never miss an episode and sign up for our newsletter. And remember, working with a financial advisor is the best investment you can make on your financial journey. For The Upside, I'm Nicole Correale.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.